we have kept the dollars that we've earned, and we have created more than $1 of market value for every dollar we've retained. And as long as we can do that, it's silly to pay out $1, even if it's not taxed, and put it in my pocket, where it's still only worth $1 if I can create more than $1 worth of value in the stock. So we have done that now for a lot of years. It doesn't mean we can do it forever, but we've done it for a lot of years, and that is the test. And you will find in the back of the Berkshire Hathaway annual report, which we'll be glad to send to any of you. It's on the internet also. But you'll find in the back of the Berkshire report something that isn't in any other report that I know of. It's something called the Economic Principles of Berkshire Hathaway. That's been in the report every year now for at least 20 years. And those principles don't change. That's why they're principles, and it's why I'm willing to lay them out. I mean, if I act in conflict with those principles, I expect the owners to, to call me on it. But I look at the investors in Berkshire as my partner. Now, I'm the managing partner. They can't, because I own so much stock, they can't do much about me. So they ought to know what the game is if they join us. And that doesn't mean everybody wants to join us, but they ought to know what the rules are. Just as if you and I were starting a partnership and I was going to run it, you'd want to know, how we were going to conduct business and what my thoughts were and what my time horizon was. Would we ever sell? Would I make distributions? All that kind of thing. So those principles cover this point you raised. I don't forget what's the third or fourth one or something like that. But it's explained there, and I want people to I want our owners to understand it. I mean, I look at every owner when I write my annual letter to shareholders, which takes me an ungodly amount of time. I mean, it's miserable. But nevertheless, it's important because it is the one time a year I'm talking to my partners. And when I started out, I actually mentally put Dear Doris and Bertie, because those are my sisters. And they have all their money in Berkshire. They're smart, but they're not financial types. I mean, they're not spending their time on that. And I essentially want to be talking to them as bright people who don't know a lot of financial jargon necessarily, but they're interested enough that they'll read a lot because they got all their money in it. So I don't have to worry about keeping it short or anything like that. If I'm talking about their money, I've probably got their interest, and I take that off at the very end, and then I take off Dear Doris and Bertie and I put to the shareholders of Berkshire. But I want to tell them exactly what they're in. I want it to be just as if our roles were reversed. That's always the test. If Doris and Bertie were running the place and I was living in Carmel, California, like Bertie is, what would I want to hear from them, the managers? And one of the things I want to hear is just exactly the question that you asked. What is your attitude about distributing money from the company? Because I get to make that decision along with the board of directors, and they don't. And some managements withhold money that really belongs to their owners because they like building a kingdom. Some of them, do it out of fear or anything like that. I think I'm doing it for a rational reason, and I want to explain that reason, and I tell them how to test me on that too, because I think I should be tested. And it's a very important relationship that really has deteriorated over the years, in my view, between management and owners. I mean, you've seen in the last 10 years a slippage, in my view, of the behavior of American CEOs. I mean, obviously, all kinds of exceptions, but it's very interesting because they're not crooks or anything, most of them. There's a few, and they've gotten a lot of publicity lately. But nevertheless, they have behaved as most humans do. They've sort of picked up the behavior of those around them. That's why it pays to hang out with people better than you are. I mean, if you hang out with people better than you are, you'll become better yourself. Everybody behaves better that's around my wife. I mean, even including me, starting from a low base. But she just has that effect on people, and other people pull you down. I mean, when I was in the National Guard and we would go to camp, in about an hour I was reading comic books. Pretty soon everybody's reading comic books. The language, every other word becomes some form of profanity. Everything. You just sink. Well, what happened to American CEOs in the 90s is that the behavior, the situational ethics, sort of caused behavioral norms to sink. I say it's a little like how Mae West described her career. She said, "I was Snow White, but I drifted." And American management drifted to quite a degree during that period. I think it's very important what that relationship is. People have given you their money at Berkshire Hathaway or any other company, and I'm a trustee for them in effect. And then the question is, they ought to, since I control the place, they ought to know the yardsticks. So if you do go to our website, go to the back of the report, and there's something that says economic principles, and we try to discuss everything that's important. And I tell them I'm going to put them in there every year so that they can, they can hold me accountable. Yeah.
You talk quite a bit about the flexibility in your many different companies and so forth. If you could elaborate a little bit on the personal qualities and professional qualities that you look in those executives that you place.
Yeah, and the question is about the personal qualities we look for in the executives we place at our various companies. The first thing is we don't usually place them. I mean, they come with them. We don't have anybody to place. So I have the problem occasionally, if somebody dies, or to replace a CEO. But most of our CEOs came with the deal. Clayton Homes, which we're buying, comes with Kevin Clayton running it. We will put no one in there. He will run the place just as before. But in terms of the personal quality, when a seller comes to me with a business, whether it's Clayton or any of the others, Ike Friedman at Borsheim's, Mrs. B at Nebraska Furniture Mart, when they come to me, the first question I have to ask myself, because I'm counting on them to run the place, I have to decide, do they love the money or do they love the business? Now, there's nothing wrong with liking the money. I mean, they all like money, but they've got to love the business. They've got to have a passion for it. Because if I give them a whole bunch of money and they love the money and they don't love the business, no matter what they tell me, 6 months from now they'll be gone. I mean, they'll just all of a sudden say, why am I getting up at 7 in the morning just so I can send a lot of money to Omaha? I mean, it won't work. So they have to love the business. I mean, I want people with a passion for the business. I used to say that I had a one-line employment form, one-question employment form. The question was, are you a fanatic? If you answered yes, you got the job. Because I want somebody who's fanatic about their business. I mean, you want people that love teaching. If you're in a classroom, if they don't have the passion for it, it doesn't work very well. So now, if they've got the passion, and our managers do, but not everybody would. The financial operators don't. We've never bought a business from an LBO operator or financial operator. They don't give a damn. I mean, all they want to do is make sure your check clears, and they're gone. And it isn't going to work if we try to buy from them. So we buy from these people who love their businesses. And then really my job is just to make sure that I don't mess it up and create conditions that cause them to quit loving it for some reason, because they come in loving it. Only I can mess it up. And they care about being treated fairly on compensation, but they don't measure it against everybody else. They don't have a lawyer they're negotiating with me. I mean, I don't have a compensation arrangement with any of these managers that can't be put in one paragraph. And then I go to other companies where they have a lawyer come in and there's 80 pages, and it tells what's happened, how much they get paid in severance if they end up going to jail. I won't deal with somebody that thinks that way. And that's fine. There's a self-selection process in terms of who comes to us. There's this invisible filter out there that causes the Claytons of the world, the Al Yoshis of the world, the Ike Friedmans of the world, the Mrs. B's of the world to come to us. When I made the deal with Mrs. B in 1983, Mrs. B had another offer from somebody else that was somewhat higher, and she just said, I don't care. She only owned 20% of the company. She had 4 children, they each owned 20%. She told them, I'm selling to Mr. Buffett. She always called me Mr. Buffett up till when she was 104. In fact, when I'd walk in the store, she'd say, here comes my new young boyfriend, which I don't get that a lot of places, I can tell you. But she built this thing. She came over here in 1921 or 2. She landed in Seattle with a tag around her neck. She couldn't speak a word of English. Said Fort Dodge, Iowa. She couldn't communicate. She just had the tag. The American Red Cross got her out to Fort Dodge. And for 2 years, she got no place because nobody spoke Russian or Yiddish actually. And so she moved to Omaha just to be around some other Russian Jews who she could at least talk to. She learned the English language when her oldest daughter, Frances, would go to school and come home at night and teach her the words. And she started sending $50 at a time over to Russia to bring her siblings. She had 7 siblings, and her mother and father to get them over here. after 16 years, she brought all the family over. She saved $500 in 16 years, peddling used clothing, whatever. And she started in the rest of furniture with that $500. And it's now the largest home furnishings complex in the world. And it all came from the $500 and a very, special woman. And can you imagine building something like that and selling it, to some financial operator who's going to resell it, and try and go public with it a couple of years later? And it meant something to her. She wanted it to continue like it has continued. And those are the kind of people we want to attract. It isn't so much me selecting them, it's them selecting Berkshire. I mean, that's the key. And frankly, we've gotten to that position in this country where the people that do care about their businesses, good-sized businesses, there's no second choice besides Berkshire. We get them. They come to us. We had a woman, Doris Christopher, come to us last year. Doris Christopher, in 1980, had 2 little girls, lived in Chicago, lived in a probably $20,000 house, and she and her husband both worked. She's looking for something to do to make a little extra money. She thought about catering and decided that it would take her away from the kids too much. So she decided that what she knew best, though, was she'd been a home ec teacher. She knew cooking, and she knew the kitchen and what was useful to people. So she borrowed $3,000 on her life insurance policy. That's all she had. She went down to the merchandise mart in Chicago and said, what's the least amount of this utensil or that utensil a manufacturer would sell, usually a dozen. And she took them home, and then she had the idea that she would hold these parties, essentially, in people's homes. And so she arranged with a woman in suburban Chicago to hold the first party. She almost turned back. She started driving there. She thought, oh, they'll laugh at me and I'll knock the stuff over and they won't buy. What'd she do? She's very unsure of herself. But she went there. She sold, I think, $175 worth of goods that night. She sold me her business last year, and that business made $140 million pre-tax from this $3,000 investment. That woman had a passion for her business, and she understood her customer, and she loved her customers. She loved the people that worked with them. She got 67,000 associates. It's called the Pampered Chef. Some of you may have been to a Pampered Chef party. Almost 1 woman out of 10 in the United States bought something from us last year. And now, unfortunately, I have to acknowledge that she probably didn't understand accounting that well. But she understood her customer, and she understood people. And she likes people. I met her one time, but when she wanted to sell her business, there wasn't anybody else to sell to as far as she was concerned. She came to Omaha. We made a deal in a few minutes. The compensation deal took us, 15 seconds. She's running the business. I've never been there. They're in Chicago. I hope they're there. I mean, we paid a lot of money for this. I mean, someday we'll buy a business and there'll just be some guy in a closet someplace saying, what figure shall I send Warren this month? But I've never been there. I've met her and I've seen the results of what she's done, and she is in love with the company. Yeah. How do I value the business that Berkshire acquires? Well, the first thing I have to decide when somebody calls me is valuing this business within my circle of competence. I don't know how to value Microsoft. I don't know how to value Oracle. I mean, if Larry Ellison calls me or Bill Gates calls me, and they don't. But if any of those, I don't know, or biotech or anything, I wouldn't know how to value it. I just, I wish them well and tell them, I think it's worth twice as much as they think it is, but I'm just not in the mood to buy today. I don't know. So it has to be within my circle of competence. My circle of competence is, businesses I can understand. And when I say understand, I don't mean understand how to use a computer or not use a computer in terms of a computer company. I mean understand what the economic characteristics of the business are and what the company's really going to look like in 5 or 10 or 20 years. Bill Gates will tell you that if he were investing, he would buy Berkshire rather than Microsoft because it's so much easier to understand what our businesses are going to look like, whereas he's in a business where you're going to really have to be doing things differently over time. So I know that Wrigley's is going to be the #1 chewing gum in the country. I know Snickers is going to be the #1 candy bar in the country 10 years from now. It's been the #1 candy bar for 40 years. You don't have to be very bright to understand that when people lay out 50 cents for something that they stick in their mouth, that they're not about to experiment. So we try to look at businesses we can understand.
Here is a key point from Warren Buffett. Warren Buffett's approach to business and life emphasizes the importance of long-term thinking, integrity, and simplicity. He believes in creating value for shareholders by reinvesting earnings rather than paying dividends, as long as those retained earnings can generate more value than the dividends would. This philosophy has guided Berkshire Hathaway for decades, resulting in substantial market value growth. Buffett is committed to transparency and accountability, outlining Berkshire's economic principles in the annual report, which he considers a communication to his partners, his shareholders. Buffett's perspective on philanthropy is equally strategic. He plans to allocate his wealth to the Buffett Foundation, which will focus on significant underfunded causes. He admires philanthropists like Rockefeller, who supported black colleges, recognizing the need for funding in areas lacking natural constituencies. Buffett's foundation aims to tackle the world's toughest problems, where traditional funding is scarce. This approach ensures that his donations make a substantial impact, addressing critical issues that might otherwise be neglected. In managing Berkshire, Buffett values passion and integrity in his executives. He prefers leaders who love their business more than the money it generates, as this passion ensures long-term commitment and success. Buffett's acquisition strategy involves identifying businesses led by such passionate individuals, ensuring that they continue to thrive under Berkshire's ownership. This focus on people who are fanatical about their businesses has been a cornerstone of Berkshire's success, attracting high-quality companies and retaining exceptional managers. Buffett also highlights the importance of ethical behavior and strong corporate culture. He criticizes the decline in ethical standards among American CEOs in the 1990s, emphasizing the need for leaders to set positive examples. At Berkshire, the relationship between management and shareholders is based on trust and mutual respect. Buffett views himself as a trustee of his shareholders' money, ensuring that their interests are prioritized. This ethical approach fosters a strong, enduring corporate culture that contributes to Berkshire's long-term success. In summary, Warren Buffett's speech underscores his commitment to long-term value creation, strategic philanthropy, and ethical leadership. His principles of reinvesting earnings, focusing on underfunded philanthropic causes, and valuing passionate leadership have been key to Berkshire Hathaway's success. Buffett's transparent communication with shareholders and his dedication to maintaining a strong corporate culture set a high standard for business and philanthropy, ensuring that his legacy will endure long after his tenure.